Well, the next company that we're focusing on is Stovekraft. Mr. Rajendra Gandhi, the MD of the company, joins us on the show. Hi, Mr. Gandhi. Good morning, and thanks a lot for joining in. Well, your numbers look quite good on a year-on-year basis. On a sequential basis, the margins have come off a little bit. But for the year, you've grown by close to around 6%, which is quite good, and actually it's better than what your peers have done. But in the past, you have guided for some numbers, and sometimes you've not achieved that. So for the coming year, FY25, what kind of a growth should we be working with? Can you grow in double digits? Can you outpace what the market is growing at? And also in terms of margins, do you get to double-digit margins backed by that big expansion we have seen in gross margins?
Good morning. Yeah, we've been growing the last 5 years at a CAGR of 19%. Last year, on value terms, we have grown at about 6%, but on volume, it is about 19%. There has been a correction in costs last year, but things normalizing. We believe we'll continue to grow at the pace that we've been growing, both aided by our new product introduction and the channel growth, various channels that we are adding.
Okay, so volume growth will be volume growth, sir. Mr. Gandhi, volume growth will be high teens?
Yeah, it will be in high teens.
Already. And what would it mean in terms of revenue growth, sir? Revenue growth as well as margins, if you could help us out with that?
Normally, the revenue growth and the volume growth goes in tandem, but because of the correction in cost last year, there is a disparity, and we believe we'll be able to grow at the pace that we've been growing at the CAGR of 19% that we've been growing. And on the margin, we have improved on our gross margins from the base of last year at about 32-33%. We are closer to 37%. We believe that there is a scope for a little more improvement, which will definitely, with our improved revenue, flow to the margins, that is to the EBITDA levels. And we are quite confident of getting back to that 11%.
Mr. Gandhi, hi, good morning. When we spoke with you in February, you were pretty sort of careful in characterizing the underlying demand environment. You'd said that, well, demand is not very strong, but it is good. It's not weak. As we have entered FY25, could you sort of characterize it for us? How are things looking?
Yeah, so I can say the demand is not great. It is continues to be at the same level or softer when you want businesses to grow. We are able to grow on both these two counts, on our channel growth and the new product introduction. But if the demand comes back to normal or better, and if there is a demand scenario, definitely the growth opportunity for us is much larger than what we currently are growing. So the current, to answer to your question, yes, it's not a great demand times. It is neither very soft, but it's not a time when we are seeing very high demand.
Mr. Gandhi, good morning. Thank you for that. I mean, that's important to understand. The demand is not that great at the moment. Your average sales per store currently stands at a little under 4 lakh rupees. Given the demand is not so good, do you think it'll be hard to hold on to that number?
No, these are early stages of our retail, and we are seeing that as the stores mature, they are able to deliver better numbers. These are because we have more newer stores versus older stores. We are only around a year old. So many of the stores are new. I believe we will settle down in the next 2-3 years, at least twice this revenue.
Twice this revenue per sales per store will double in the next 2 to 3 years, right? That is the kind of guidance that you have. Got it. You've added 31 new stores in Q4. What is the plan for FY25 in terms of store additions?
We will continue to at a run rate of about 25 to 30 every quarter.
Oh, okay. All right, Mr. Gandhi, I recall that you had said, you all will laid out some Capex. I think this was post-COVID. So could you tell us for the last year, what was the Capex spent? And with this incremental Capex, at optimal levels, what kind of revenue number can you achieve? For the last year, you've done 1,350 crores. But at optimal level, with this Capex that you've done, what can you achieve?
We started this Capex cycle middle of the COVID, and the last 3.5 years, we've been investing. We are at the concluding stage of our Capex. Last year, particularly, we invested around 80 crores. And with the overall Capex that we have done, which is about 350-360 crores, and with the concluding Capex, around 400 crores of Capex have been done in the last, we will have invested in the last 4 years. With the current investment that we have done on our manufacturing facilities, we can get to between 2,000 to 2,500 crores of revenue with the existing Capex.
Oh, okay. So effectively, you can nearly double your revenues if demand is good. For the time being, it's a little softish.
Yeah, I don't say again is very bad, but I think the opportunity and the possibilities are very high because
Okay.
at the pace our country is growing and all the macroeconomic conditions, we believe that when the things stabilizes a little more, demand will come back, and with that, the opportunity is there.
Is there a bit of, 2 points, Mr. Gandhi, is there a bit of down trading, just to take that point forward, or no?
No, so we are a cost plus company. We believe on, we want to, of course, have a healthy margin, but
Right.
whatever is appropriate to our company. And whenever there is an advantage in cost, we pass it on. And if there is a price increase, there is an inflationary trend happening
No,
in our.
I meant down trading for consumers opting for cheaper products. I mean, that just to follow up to that demand question, or no, not really?
I will tell the country is very price. I mean, majority of the population in this country is price conscious. It does not mean that they will go for lower quality products. But if products available at better prices, definitely they will choose this, and they are very, very price conscious. Particularly when people want to save money, then they become more conscious. Currently, I
Yeah.
think they are going through that conscious stage.
What about rising sort of underlying prices, steel, aluminum? What does that do to margins in 25?
Currently, they are coming back to normal. We had advantage over in the cost last year. There is, compared to the last year, the prices are going up, but it is not very volatile. Definitely, they are coming back to the original levels.
Okay, just one final question. Your revenue breakup, right? You have pressure cookers, LEDs, large amount, of course, comes from pressure cookers, induction cooktops, etc. But do you plan to change your revenue mix over the next couple of quarters?
We will continue to be in the segments that we operate. Our appliances category is performing much better than our main categories of cookware and cooktops. So that is also aiding higher growth. But even in our pressure cooker, we are doing very well on the volume growth. Of course, as I mentioned, there was a correction in the cost which we passed down. So on the value growth, we are not able to witness any value growth in the pressure cooker.
Okay, thanks a lot for joining in. Appreciate your time and thoughts here. That's Stovekraft. But